Hello, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is my good friend Mike McGlone, Senior Commodity Strategist at Bloomberg Intelligence. Welcome back, Mike.
Thank you, Ivan. Thanks for having me back.
Yeah, I have you. We had you on last week, and we had, come a couple different opinions on the Fed. And where did we end off last time, and what happened after that meeting, after our interview, Mike?
Well, I guess I made the mistake of being with consensus that there was little reason for Chairman Powell to pivot and signal ease. Wrong. So he did. And the market has really started pricing for a lot of ease. And since that has come out, like today we're recording this on the Thursday, the 21st.
Right.
We just got the core PC um, numbers and the price index, and they're all kind of meeting the Fed's target at 2%. So markets had a relief rally, and particularly in gold, but virtually all risk assets have done pretty well. And thank you, Mr. Powell, for signaling pivot.
And a lot of people online, I've seen a lot of comments and talk about, well, now that they signaled that they're going to reduce in 2024, that it's going to fuel inflation again because people are going to pour into the market and more money will go into stocks.
Yeah,
And that's a huge concern that as they
yeah.
reduce the interest rates in 2024, inflation kicks back up again and they didn't hold it for long enough. What's the outcome there and what happens to stocks, gold, energy? What happens there?
Well, I think it's a legitimate concern. And you've heard Fed governors push back saying, okay, market right now is priced for almost 150 basis points of cuts next year, which
Right.
is a lot. And they might only cut 75 basis points based on the dot plots. And I think what's happened is very unique is the market, all the rate hikes went up, and it was like the fastest pace ever, straight up on the elevator. And I
Yeah.
think when they start going down, it's going to be down in the escalator, and it'll be a wait and see kind of thing. Plus, we have a presidential election year. Some people are looking at that as a reason to pivot. I'm less biased with that. But the way I see it now from a broad commodity standpoint, let's tilt over to the stuff I know really well, is
Right.
gold is basically beating everything. And particularly industrial metals. Industrial metals are all tilting down. The Bloomberg Industrial Metals Index, if you look at the broad index, is down about 11% on the
Hmm.
year, and gold's up about 12% on the year. I think the risk is that's going to accelerate. So one of the key reasons that Bloomberg Economics pointed out that the Fed pivot is because the beige book, the beige book that came out, the latest measure that came out the end of November was was tilting negative for them. So they've met their inflation targets. The rate hikes might be finally starting to kick in a lot later, most people thought, and now they're signaling. I think it's come somewhat of a CYA. But from a
Hmm.
market standpoint, to me, the biggest risk is just the exact opposite of the consensus last year. And the consensus was, oh, we're going to a recession. Everybody thought that. Stock market was pretty beat up. We didn't have the recession yet, and stock market's rallied a lot, 50% in Nasdaq. Now that we've all priced for the other side of the pendulum, and everybody's priced for the opposite, the soft landing, the to me, just the normal tilt is to mean revert that pendulum and risk assets going up a lot. But the key thing I like to point out is from my standpoint from commodities, we're seeing pretty significant deflationary forces from commodities. And
Right.
my headline from my commodity outlook for the month of January is please save us the stock market, commodities, because if the stock market doesn't stay resilient, just picture next year. We already have that tilt towards a normal cycle. Commodities got too hot in 22. They've reverted a little in 23, and they're heading downward in 24. Something needs to save that, stop that trajectory. And if the stock market goes down, that's a double whammy, deflation really accelerating. And I think the Fed would just follow with rate cuts. So that's clearly what I'm seeing from like energy. The Bloomberg Energy Index is down almost 20% this year. A lot of that's natural gas. Crude oil's just picking up.
Hmm.
And then I always like to tilt over to the metals, industrial metals, platinum, palladium, down a lot. But silver's kind of stuck in there with copper.
Hmm.
And, for the name of your show, I'm still worried that next year gold is still going to outperform most other commodities,
Yeah.
particularly most other metals, in a Fed Reserve pivot as the world tilts towards recession. And that I don't want to go too long on that, but we do have that serious property crisis in China, just potentially getting as bad as it was when Japan peaked around 1989-90.
Hmm.
And we have this serious tilt towards recession in Europe, and there hasn't been it's only been a few months since the last rate hikes out of the ECB and the Bank of England. We haven't, no one's really started easing yet. So typically you need a pretty long lag to the start of easing cycles, to end those kind of trajectories.
So I just wanted to let everyone know about our new sponsor, Strategic Wealth Preservation. They are an international precious metals dealer and they are a secured storage provider that have headquarters in the Cayman Islands. The company owns and operates a large Class 3 UL rated vault in the Grand Caymans, and they offer other strategic locations as part of its global storage network. They specialize in the acquisition, secure storage, and liquidation of precious metals for individuals, companies, trusts, and wealth management professionals on behalf of their clients. So if you guys want to check them out, the link is in the description below. And do you think, Mike, the Fed runs the risk of gold going too high and it actually, the US dollar going too low because it's not backed by gold anymore? What's the issue? Like, let's say next year comes 2024, they start reducing rates, inflation goes out of control, hypothetically, gold still goes up. Yeah, does the Fed run the risk of the gold going way too high? Because, yeah,
Well,
what do you say?
let's put it this way. I do think gold's going to go way too high. I think it has to get expensive. It's been
Right.
relatively cheap for a while, in my view. It's finally converting $2,000 an ounce of which was resistance into support. I think it's just a matter of time it heads towards three. Now,
Absolutely.
and there's a lot of noise in between there, but I'll let the day traders figure that out, and I'll have better ideas when we get there. But the key thing to remember about the dollar is versus what? Versus gold. I think the dollar is going to continue to weakness, but versus a basket of fiat currencies, let's look at the top three economies in this planet. If the Fed cuts 100 basis points next year, it puts the upper bound at 4.5%. Um, that's many X's times the rates in China, in
Right.
Japan, and Germany. It's like, what's the problem there? You still, and then there's this issue, what's happening lately in the Red Sea. You see the value of the US dollar. Imagine if the US was not spearheading and leading the safety on the open seas.
Yeah,
You
yeah.
just see the value of the US currency, and also you get the best rates in the US dollar. So I still like to point out people who are poo-pooing and pushing back in the dollar. Here's the main thing that I think you need for the dollar to have pressure is what's really boosted and coincided with dollar strength for at least since 2009, 10, 11, when the dollar bottomed.
Right.
And that is the outperformance of the US stock market. So that to me is the lose-lose there. At some point, this outperformance period will mean revert of US stock market versus the rest of the world's stock markets. If and or when that happens, that's your trigger for the dollar to drop. What does that mean though? Everything falls exponentially with the US stock market. If the US stock market doesn't stay resilient this year, by the time we have this conversation next year, we'll be talking about severe deflation, is my view. So dollar though, remember though, versus a basket of fiat currency, give me a better one. Maybe Swissy, but honestly, a basket, nothing even close, not even
Right.
close. And then when it comes to security, we see what's happening in China. Their property crisis. Every single time I get onto Bloomberg and I type in NI China or BI
Oh
China,
yeah, it's
it's
crazy
just
there.
it's just worse and worse and worse. And it's just logical reversion that I worked for Japanese firms for a lot of my career. I remember seeing
Right.
it in the early 90s. I was a market maker and trader in JGBs, Japanese government bonds. I remember in
Wow.
1994, 95, every single client said, we're short and happy, we want to get short. They were all wrong. Why? Because
Wow.
that implosion just accelerated. It's just getting started in China, and their main customers, their export customers. Europe, number one, is going to recession. Remember, they start hiking rates. The U.S. will probably get that slowdown. The Fed's not going to start easing unless we see a slowdown, and that's trickling down in just a matter of time. And then the internally property crisis. I mean, unemployment. It's just way overdue in a typical emerging market that goes towards the model of autocratic leadership.
Yeah, absolutely. And we were seeing like at first it was Evergrande, and now there's like every week you're seeing a new real estate company in China start to go under, and I'm sure it's affecting other sectors as well. If it does end up really hurting their economy bad, all these real estate collapses, do you think the contagion would spread to the US though?
Oh, sure, everywhere,
Yeah,
everywhere. First, the lesson we've learned about Mr. Z is ignore what he says, watch what he
right.
does. When he went to the economic summit in it was at Seattle, I forget where it was in the U.S. In November, that was a shocker to me. He basically came in and he played nicey nice, and I think partly
Yeah,
because he
yeah,
sees what's happening. And and this is a guy who who hugged and cozied up with Vladimir Putin right before the invasion and pushed back in Jack Ma. So to me, that's indicative of what's happening. But it's trickling down for everything everywhere. I mean, where's Germany going to export to? Germany's already technically in a recession. The
right,
wealth creation machine of Asia for at least the last decade, the minute that China surpassed Japan's GDP around 2010, which was around $4 trillion, and is still around $4 trillion now. China's GDP is closer to $18 trillion now. The minute that happened, it created a lot of wealth effect, which is just due for a little reversion. So to me, that's the trickle down for everything. Now you're seeing that in the industrial metals. You're seeing that in certainly commodities and crude oil, and gold taking off.
right.
So those are the way I look at it. If there's one central bank in the world and it had one indicator, just commodities, the signal right now you should be easing already. That is industrial metals heading lower,
Right.
and virtually heading lower and gold heading higher.
Yeah, no, it's crazy times, and it's such a pleasure having you come back. Even though you were on last week, it's such a huge pleasure having you come to Wall Street Silver and talk about the commodity sector and everything else. So thank you so much, Mike. It's a huge pleasure. Where can people connect with you?
Thank you, Ivan. Thank you for having me back, particularly after that little pivot from Chairman Powell. I'm on Twitter at Mike McGlone 11 and LinkedIn, Mike McGlone, Bloomberg, and I'm happy to put people on my distribution list. If you shoot me out a request, give me an email. I'll do that. So, and happy holidays to you and all our listeners and viewers.
Yeah, happy holidays to you, Mike, and everyone watching. Such a huge pleasure, and then talk to you soon.